Welcome to the launch of the Australian Small Companies Fund. My name's Gaurav Sodhi. I'm Deputy Head of Research at Intelligent Investor. I'm joined today with two of our senior analysts. We have Alex Hughes. Say hello, Alex.
Hi, guys.
And Jon Mills is with us as well. Welcome, Jon.
Hello, everyone.
Guys, we're here to answer questions that are coming in, and I see there's already a couple there now. Before we get to those questions, though, I thought we'd just introduce what we're trying to do with the fund a little bit. Alex, why small caps?
It's an area of the market where we think we can add value through active management, and it's been an area of the market that Intelligent Investor hasn't covered in the past. They've tended to cover sort of the mid to larger cap companies. So it's a new area for us, but we think that it's an area of the market where perhaps there's some inefficiencies there, and if we start to drill down and research some of these companies, we can add some value there and provide a decent service to some investors.
And there's a lot of specific reasons why small caps in particular may be more inefficiently priced than large caps. It's not just the fact that they're small. Lots of companies simply can't invest in, lots of funds can't invest in smaller companies. They're restricted by size or by mandates. What are some of the other sources of inefficiency in smaller companies?
Exactly. I think you can use the term structural inefficiency because, as you said, there's reasons which prevent many investors from investing in the sector. So illiquidity is one. So if you manage a lot of money, it's very difficult for you to invest in the smaller cap space, and that really keeps a big portion of the institutional market out of the small cap area. And of course, on the research side, a broker just can't justify spending the time to understand a company when the potential brokerage commission pool is very small there. So, those are two things which are very real and are likely to stay there for a long time. So provides an opportunity for smaller guys such as ourselves.
Now, Jon Mills has just admitted off camera that he's never bought a pair of socks outside of an 8-pack. So it probably qualifies him as
only
the...
coloured black as well. So.
Only black. Yeah. So you're probably the hardest core value guy amongst all of us. What is it about small caps that interests you? Why small caps?
Well, I guess partially because when I first started into the value investing world, obviously, like most people, I studied the best investors, and the best value investors started off as small cap investors for the most part. And I really like finding things that most people aren't aware of, and looking at off the radar, and hopefully it turns out to be a good investment. But I just like getting into the nitty gritty of these small stocks that.
Okay, well, let's get into the nitty-gritty of the fund because it's not structured the way our larger funds are structured. Those use a separately managed account structure. Talk to us, Jon, about the structure of this specific fund.
Yeah, so with the growth and equity income portfolios, you can invest in them via SMAs. So that means you are the legal and beneficial owner of the securities in the portfolio, and your money isn't pooled with other investors in that model portfolio. The small cap portfolio is, by contrast, a unit trust. So that means if you choose to invest, your money will be pooled with everyone else, and then that'll be invested in the various holdings of the fund. Now that has tax effects as well. In an SMA structure, your tax situation depends on how or when you invested and what happens to the underlying holdings. In the unit trust, your tax situation to a great extent depends on, I guess, previous tax events that have happened, or previous events that have happened before you became an investor.
There are lots of advantages to the SMA structure. I like it a lot. But when you're investing in smaller and potentially illiquid businesses, the SMA structure does not work. And so we've specifically chosen the unit trust structure because that's what suits the kind of companies that are going to go into this fund.
Yeah, and it gives us the flexibility to ask brokers to maybe buy a position in stages rather than when we put an order into the SMAs, unless we tell Premium to structure the order, that order will be spread out across all the SMAs. Correct. And with larger stocks that's fine, but small stocks you could get penalised by lower liquidity and hence pay a higher price or sell at a lower price.
Now, Jon, talk to us about the fees associated with this fund. The fee structure is a little bit different as well. Let's just unpack that.
Yeah, so the small cap portfolio have the management fee, which is 0.97% per annum. And there's also a performance fee of 10.25% per annum. Now, there are two benchmarks for that performance fee. We'll only get paid if we beat the benchmark, which is the Small Ordinaries Index, or the RBA cash rate, so whichever is higher.
Whichever is highest.
Yeah, and so the idea behind having that RBA cash rate benchmark as well is that we don't get paid a performance fee if we have a negative return, but it's higher than the return of the index.
And this is a really common problem for funds, especially I would say small cap funds. In the year where the market is down, you may have lost your client's money, but you can still collect a performance fee, which I think is outrageous.
It is, yeah.
Our fee structure ensures that we will never get paid unless we make at least positive returns and meet the cash rate at a minimum. But there's a higher watermark as well. Do you want to just run through that?
Yeah, so the idea behind the high watermark is just say that in year one, the portfolio does 20%, the benchmark does, say, 10%. So we'll get a performance fee. In the next year, if we lose 10%, we won't get paid a performance fee until we make that 10% up. So unless we get back to our previous highest NTA on which we were paid performance fees, we won't get additional performance fees.
So the fund can't have a bad year and then recollect fees from a lower base. We have to reach the highest base and collect performance fees for real growth. Okay. Well, that about covers. Oh, look, the other point I want to make quickly, fellas, is that the other great thing I think about using a fund structure for accessing smaller companies is that it allows you to outsource your portfolio management as well. You know, there are two ways to make money in the market. One is with great stock selection, and the other way is really good portfolio management. I think with larger companies, it demands less portfolio attention. With smaller caps, you really have to watch your portfolio management far more carefully, and it's a more rigorous exercise. So inside this structure, you get access to our own stock selections, but you also get access to our own portfolio management. We're watching those things all the time, adjusting weightings and taking profits as we see fit. So I think that's another important part to generating returns in this part of the market. But let's get on to questions. There's several waiting. Now, the first one comes from Sean. Hello, Sean. How do you assess a small company's capacity to grow to a medium and then a large company? And then Sean asked if we use a specific type of growth model. I think this question speaks to our stock selection process. So let's try and answer that a little bit. We have a very specific process we use. It's actually very similar to the process we've used for over 20 years in selecting stocks for our larger portfolios. Alex, it doesn't change very much, does it?
It doesn't, and it involves assessing a company on its merit. So it might differ between companies you're looking at. To provide an example, maybe RPM Global, which is a mining software company that the members will be familiar with. We've written it up on the site there. We like it because we think it has the potential to be a much bigger business in time. So, we appreciate the opportunity the company has in front of it. But what we're thinking about on a day-to-day basis is, do they have the right strategy? Are they executing on that strategy? And are they meeting expectations on an incremental basis? And it's really about, does the company have the potential to grow, and are they doing the right things to ultimately get there? So it doesn't happen overnight. It's sort of an incremental process.
I sound like a shampoo ad for a moment there. John, the point of selecting small caps isn't necessarily to buy a small company thinking or wishing it gets into a larger company. We're still trying to buy mispriced securities, aren't we? We're just looking at a different pool.
As you said earlier, it's the same process that we followed pretty successfully for the past 20 years in not only on the site, but also in the model growth and equity income portfolios, which have subsequently become investable. It's all about looking for a margin of safety and quality management, and it's looking at its position in the industry and so on. So I think you can get waylaid by looking at a small company and thinking, oh, geez, if this is successful, it could be 10 or 100 times larger.
I actually think that's one of the great mistakes of small cap investors, is that they try and buy companies that are small and growing very, very quickly. And the market's actually very good at pricing companies most of the time. The opportunities in small caps is to look for the maligned and the neglected, ones where there is a mispricing for some reason. And that's where we're focused all of our attention, in fact.
Exactly. It's very hard to build a portfolio around the former strategy, because if you want these small companies that are going to turn into large caps, there's very few of them. They're often priced very dearly, and it's hard to have a portfolio of 20 names with such ideas.
And for every company that does go from small to large, there are 20 that stay small or get smaller.
Exactly.
So it's not as easy. Or go bust, yeah. It's not as easy as it sounds. Look, we've got another question from Jimmy B, who asks, with your new small cap fund, the management fee is 93 basis points, and you have a performance fee. Will you refund or credit the performance fee if you underperform? as Magellan has promised to do this. Magellan promised to do that. I don't think that's quite.
Yeah,
I don't
accurate.
know. Hamish says lots of things, and I can't keep up. So
yeah, no, I don't think that's
let's assume
quite
that
right.
he's correct. And
Okay, but talk about that. I think this speaks to the high watermark you're talking about, John.
yeah, so I mean, as you mentioned earlier, the idea is we don't get paid performance fees on the same gains. So if we make a gain, then make a loss, and then recover that gain, we won't get the same performance fee. We've got to get back to the previous high watermark, so the previous high NTA, and then if we do better than that, we get a performance fee.
Alex, sound okay to you?
It does. Just to add to that point, I think the management fee is 97 basis points, and the question was 93. So
Very good.
Just wanted to clear that up.
Glad you know what our fees are.
And also, sorry, while we're just on that question, we might as well talk about the benchmark being the small ordinaries. We had a few comments on the recent articles on the small cap portfolio. I mean, the reason the small ords is the benchmark is the portfolio is investing primarily in companies outside the ASX 100. Well, I mean, our mandate says we can't invest in companies whose market caps are greater than the biggest company in the small ords index. And so if we're investing in the types of companies that the small ords index represents, that I think is the most appropriate benchmark. I mean, we wouldn't, perhaps this isn't the greatest analogy, but if we were running a bond fund, we wouldn't have a benchmark for the ASX or ords. So if you're investing in certain types of companies, that should be a benchmark that includes those types of companies should be the benchmark.
Sure.
And another way you can think about it too is that if you wanted to take a passive approach to investing in small companies, you would invest in a small company index. Yeah. And so we're trying to beat that passive approach with active management. So we benchmark against the passive index.
Yeah, and the fact that, so far anyway, our performance is a long way ahead of that benchmark, I think speaks to a general point about how valuable active management is as you get smaller and smaller in size in terms of the companies you're looking at. Probably less important if you're looking at the larger end, vastly more important as you get to that smaller end.
Absolutely. I mean, we did a presentation internally a while back and we looked at the number of analysts that cover some of the larger companies. And, you know, for CBA, there might be 20 analysts. But when you look at a $100 million company, they're lucky to have one analyst on average.
And it's usually the youngest guy who hasn't put his hand up for the job.
Yep, exactly. So there's less competition and the potential for better returns.
Yeah. Okay, another question coming from Eric, who asks, will the research on small stocks be published as official reports and recommendations? Eric, really important point. We brought Alex on board specifically to look at small caps, and his mandate was always to work on the fund and also to provide provide content to the website as well. And Alex, you've published a lot of research on smaller companies, and that research is used both as fund work and also as standalone investable advice on the website.
Yep.
What's the proportion of companies that sort of would be on the website and in the fund? What's the crossover like?
So the fund currently has 18 investments, and it's a little less than half of those investments that have been published on the website. So members will be familiar with RPM Global, 3PL, Thorn Group, FSA, Mason. I mean, there's a number of names there members will be familiar with. And so some of the other companies are just not suitable for the publication, largely due to illiquidity. You know, it's just when we've got a large member base and, you know, they all want to buy at the same times, you know, and they're competing with each other for a stock that is hard to buy. You can have some members, you know, might pay a much higher price and some members might get a much lower price. And so they don't get the same outcome from the same recommendation. So it's problematic. So those ideas tend to go towards the fund and that's how it's panned out thus far.
John,
sorry.
Go ahead.
No, just to add to that, I mean, we want to be careful not to essentially take advantage of our large membership base. So if we recommend a really small stock that has no liquidity, we could recommend it knowing that a lot of our members will buy it and push the stock price up. So we want to avoid the appearance of I guess, pump and dumping, you know, just to make sure everything's above board. And so that's another reason why we won't be publishing research on these really small illiquid companies.
Well, the only way we can really help people get access to these companies is through a structure like the fund. I mean, you're right. If we had simply set up a separate small company service, you wouldn't really benefit from the same sort of portfolio management, which I think is really important in generating better returns. And B, illiquidity is a source of opportunity, but it's also a huge hurdle that one must overcome. And you can overcome it in a fund. I can't see how you can overcome it in a publication service. The only strategy available to us is to not mention those really small liquid names. So unfortunately, for the benefit of everyone, then there's various parties we have to trade off interest with. I think that is the structure that works best. Another question coming from Leo, who asks, am I right that the small odds index performance over 10 years is negative? Why is that? And how do you think about addressing the problem? Is it actually negative, John? Is that right?
Well, it hasn't done well.
Okay.
I'm not sure if it's technically negative, but I think one of the reasons is it contains a lot of resource companies, which are obviously very, very cyclical.
And over 10 years, you can imagine over a 10-year period, you would have had a high representation of resource companies 8 years ago and a very small representation now.
Exactly. Yeah.
And I think most indexes have done very poorly over 10 years, not just the small odds. Even the main indexes from 2007 haven't done very well.
That's right. I think, John, the ASX, all odds is probably negative territory over 10 years, would you say?
I think so, yeah.
I don't think it's gotten back to that 6,000 level.
Exactly, yeah.
Geez, you can tell we're on uncertain ground here. We don't even know what the index
what
levels are.
Yeah. I remember when I was interviewing here at Intelligent Investor, one of the first questions I got was, what was the value of the All Odds? I had no idea.
Yeah, I'm with you.
I think I was out by 50% or so. But,
yeah, I think that says a lot actually about the way we look at stocks.
Yep, index unaware.
Okay. Another question coming from a name I cannot pronounce, I'm sorry. Given the intention to limit the fund size, why not make it an LIC or LIT? John, why don't you take that one? Talk us through some of the reasons about why we chose this structure.
I think, firstly, you require a minimum of $20 million, I believe.
50 million, is it?
Well,
there's a minimum anyway.
Yeah. To at least structure as an LIC and put it on the ASX. And obviously there are costs and fees involved to do that. And so, I mean, we don't know how popular this fund is going to be. So I think that's the major reason. I mean, I don't know if you've got anything further to add, Alex?
Well, no. LICs, I have to say now, I think LITs are a really innovative and interesting structure, but you really have to be an existing fund and transfer over to an LIT. I think that makes more sense than starting an LIT from scratch. LICs, I just don't think they're in investors' interests. They always trade at a discount. They should always trade at a discount. If they don't, because there's a value leakage inherent in that structure, and I don't think it does. That structure is in the best interest of investors. And I think you'll find a lot of good investors shy away from that sort of structure specifically for that reason.
Yeah, I mean, you've probably seen in recent years the number of LICs on the ASX is
exploded.
Exploded. And one of the main attractions from the fund manager's point of view is that it's permanent capital.
Yep.
So they don't have to worry about, I guess, temporary underperformance, hopefully. Because in the case of this small cap, it's a managed fund, if we underperform, investors will quite rightly take their money out and the fund will be very, very small, if not no longer existing. So
you make a good point. The person who benefits most from an LIC structure is the fund manager. They get a stable permanent capital base, which means a stable permanent income source, and that's very beneficial. I don't think the investor does very well out of it. Guys, should we talk about a few of the ideas that we've been working on? We have to be a bit careful because we're still trading and buying, so let's keep it all above board. But Alex, talk us about one of your favorite ideas in the fund.
Okay, I'll talk about one of the more recent ideas, which would be Adicel. So this is a company that we have written up in the publication. It's a software business that has a large operation in the US and the North American market. And it has two businesses. It provides a training solution that air traffic controllers use to train and become employed air traffic controllers. And it also has the software that's used by air traffic controllers in their line of work. And we like this company because it's a very high quality company. It's got about 90% market share in the training product. And so if you want to become an air traffic controller in the US, you have to use this product. And so it has great sort of an entrenched business model there, great cash flow characteristics, and we think it has a bright future ahead as more air traffic controllers are trained and the market grows. And also the international air traffic management business. So this is what the air traffic controllers use in the line of work. Used all throughout the world, very entrenched. Once these systems are installed, they're there for a long time. I've heard analogies about the US air traffic management market, and they're still using a system that was installed 40 years ago, and it's very difficult for them to move off that. So that just shows just an indication of how robust a product like that is. So it's one of the recent additions there. It's done reasonably well thus far. It's been a bit problematic when you're trying to build a position and the stock's going up, but yeah, we think Adacel has a pretty good future ahead.
Now that's a good example that ties in with another question we've just received. And the questioner asks, a lot of small caps are quite specialized. How do we go about accessing the specialist knowledge that requires analysis of competitive advantages and market position, all that sort of thing? We've just discussed, you've just outlined the investment case for a business that's as specialized, I think, as it gets. None of us have a degree in flight management. We don't know anything about the software itself, but we are business analysts, and businesses all work pretty much the same way, and there are a simple and standard process one can apply to businesses that reveal lots of different things about them. Simply by following that process, I think we can generate excess returns. It's the same process we use for larger funds.
Yeah, and I think one of the advantages of small caps is they're usually simpler businesses. They may have one product or service.
This might be a bad example of that.
Yeah, but
you're right, they are generally
compared to,
simple.
say, a conglomerate or a business that has various divisions doing completely different things.
Yep.
I think it's a lot easier to learn about a small cap that's much more specialised.
Now, John, someone else asks, are there any sectors that we would completely avoid? Are there anything that's off limit in the fund?
No, I don't think there is. We don't hold any resource exposure at this stage. We do have a bit of mining services.
Yes, we do.
Exposure in there, but potentially we could invest in resource stocks down the track. It's a very open mandate, and as always, it will just depend on value and whether it's available or not.
I think that's a really important differentiator for us. There's a lot of funds that openly say, look, we're not going to invest in resources because the price is always unknown. They're price takers. I think it's a really lazy form of investing. Simply to write an investment off, and that means there's opportunity in there, and people aren't thinking, they're acting without thinking. And that's prime hunting ground for us.
Absolutely, yeah. The mandate that we have was built with flexibility in mind, and I totally agree, Gaurav. And we have the ability to look across the market, and you see lots of funds out there that are promoted based on a particular investment approach or
a narrative.
Or targeting even specific investments, like we invest in enterprise software companies and things like that. And when you box yourself in like that, what happens when the opportunity set moves, So we have a huge amount of flexibility, and we can go to where the opportunities lie on a given day.
Yeah, we were actually looking at a miner a little while ago, and it didn't go into the fund, but we are open to lots of different ideas, and nothing is off limits. Now, another comment comes from Michael. Do you have a view on the portfolio weightings the small cap fund should be? Portfolio weightings is a really important part of how we expect to perform in the fund. I think, we can't really give general advice. It really does depend on the individual. In my own portfolios, in fact, in all of our personal portfolios, we invest. I invest without regard to size. So some of my largest positions are actually small caps. And I don't have that kind of demarcation between I allocate this much to large caps and this much to small caps. That's just me, but I don't see why.
You are still young, Gaurav, as well.
Oh, it's very kind of you to say so, John. But I don't see why the size of the business necessarily should dictate where your flows go. I think the stock selection and portfolio management is still more important.
Yeah, and so in terms of the actual portfolio,
that's right. Yeah.
I forget the exact number, but I think the minimum is 10 stocks and the maximum is 25.
Yep.
Is that right?
That's right.
And so we have a maximum of 15% in a particular stock. We're not allowed to have more than 15% in a particular stock. At the moment, the weightings vary from below 2% to just under 7%. And as Alex said earlier, there are 18 stocks in the portfolio.
What's the largest weighting we would be prepared to take, John? Oh, hang on. What if Alex says something different?
Yeah.
No, go ahead.
I think as an initial investment, as a total investment, I'd say 7%.
Yeah, I think that's the number. When we sort of sat down and talked about position sizes and how we're going to tackle allocation decisions, and every time we make an allocation decision, it's a investment committee process. So there's actually the three of us, along with James, sit down and thrash it out.
And I guess we have included a 15% maximum just to allow for that rare opportunity.
Yeah.
It's unlikely, but it may arise at some point, and it's an idea we'd probably have to deeply consider and explain to our investors why we're taking such a big stake in it.
That's right.
But it's unlikely.
But it's nice to have that flexibility to take those very large positions.
Yeah.
It can be a great source of outsized returns.
Yeah.
Another question that pops up is about key man risk. The question is saying that Platinum clearly has a key man risk. Do we have key man risk as well? Now, I know all three of us would like to say yes. But in truth, John, why don't you explain that?
I don't think so. I mean, if I was to get hit by a bus tomorrow, I think the fund would do just fine. So,
or if one of your colleagues were to clobber you over the
yeah,
head.
which is probably more likely.
Yes,
but,
I think so.
So I think, we don't have that. I mean,
I mean, the process is a collective one. So as I said, there's four of us who sit on the investment committee. Our CIO is in there as well, although his role in selection and allocation is less than the four of us. And so all four of us make democratic choices, which means that some stocks that one person is fond of, for example, PMP, may not get an allocation in the fund if other people don't like them.
And also the culture as well. I mean, I'm still reasonably new here in the team. I've only been here about a year, and so I still sort of see the team and the business with a fresh pair of eyes, and I am impressed by the culture here, and I think that it could be enduring even if we no longer existed. So I think that adds to the mitigation of key man risk.
Well, that's an important point because we've had several research directors now. I myself have worked under three of them, and it hasn't really changed our outcomes or our processes at all. Alex, what is the optimum size of the fund? Now, this is a curler. I'm going to leave it with you. Yeah.
We haven't disclosed this yet, and I'd say we haven't because we don't know ourselves, and we're still working through that. We want to stay small. That's our key focus, and we want performance to be the priority. And we have a small fund thus far, and that's allowed us to invest in some smaller illiquid situations, and we've had some early successes doing that, and the bigger we get, it just restricts us from doing so. So, whether that limit is 50 million, 100 million or 150, we haven't ultimately decided, and I think it'll take time for us to ultimately decide, but we haven't reached that point yet.
Now, correct me if I'm wrong, fellas, but we are all committed to running a fund that generates outstanding returns. I don't think we're interested in running a larger fund that generates slightly above average returns. I think we're all in here to generate very good returns, even if that means running a smaller fund.
Yeah, and I mean, obviously, for those who don't know, InvestSMART is listed on the ASX under INV, the symbol, and our shareholders would love us to just get $1 billion or $2 billion under management, as many funds under management as possible. But the bigger the fund, the harder it is to outperform, particularly in the small cap space.
And you see this all the time. I mean, the investment world is littered with great fund managers who were forced to become merely good fund managers simply because they had too much money under management. And we've decided early on that we don't want to do that. So we will have soft closes. So we won't accept money when we are fully invested and don't have ideas to put money into straight away. But once we have new ideas, we'll open the fund again. As Alex says, there will be a time where we don't accept any more money permanently, but we're not going to say when that is, and it will depend on the opportunity
situation. Yeah.
Indeed, yeah. All right, now, fellas, there's another one that might be right up your alley, actually. Someone has asked about our own holdings and our own skin in the game. It's something we sometimes look for in the businesses we run. I think it's important that investors ask the question about the managers of the fund as well. So let's disclose who owns what.
So I'd put most of my super fund in it, and it will be 100% invested in the fund once I sell one share that I still have, which will hopefully go up in due course.
Okay.
So I invested soon after we were allowed to invest.
And Alex, you're invested in the fund?
I am, yes. Also invested a fair amount through my super fund, and intending to invest more when I also sell one particular holding. So it's sort of like a legacy holding that I'm working through, and ultimately it'll be sold and invested in the fund. But at the moment we've both got plenty in the game to incentivize us to want to do well, and it's our money's invested in there too, so we want a good result, and ultimately it's the track record of the fund which is what we're striving to be proud of.
Yeah. Now, I must confess that I have not invested yet, but that's only because I was in the process of purchasing a house and I needed every dollar I could scrape. If you live in Sydney, you'll understand what I'm talking about. That deal hasn't gone through, so I have put my hand up to put a big pile of cash at the fund as well. So that will be popping in soon. So we'll all be fund investors, and I think it is important. It's important that our experience as investors is the same as yours, but we really also want to get the track record up, and as Alex says, we want to build something we can be proud of.
That's right.
Yeah,
and
definitely.
Even the wider group, I know there's a number of employees that are invested in the fund.
That's
as
right.
well.
Yeah.
So it's not just the
quite a
team.
few, in fact.
Yeah.
Yes, it surprised me how many people put their hands
Yeah,
up.
so the
straight
pressure's
away.
on.
Yeah, I think investor number 2 was a new hire we had in Melbourne, in fact.
Yeah. Young Mickey.
Yeah, that's right. Well done. All right. Now, another comment coming from Fred. Would it be fair to assume that currently held small caps in the model portfolios, such as Fleetwood, would be a shoo-in for this fund? Now, that's an interesting question. Alex, the relationship between the SMAs and this fund, there is no mechanism that says simply because a business is small and in our existing funds that we must hold it in the small cap fund. Every business that is up as a potential investment goes through the same formal investment process. Talk us through how that works.
Yep, so we have ideas coming from the three of us and also the wider team. And so a company can be put to the team and we can assess it on its merit, and it can be invested where it makes sense. So it's possible that we have crossover between the funds, because if we have good ideas, it makes sense for us to invest in those good ideas. And so for some of the companies mentioned, it's likely that we've invested in both, and in fact we have in terms of Fleetwood's case. So yeah, it's about getting the good ideas invested in the fund, and there'll be crossover there. But ultimately, this fund is trying to target smaller companies, and the traditional growth portfolio is sort of in the mid to larger cap space. Yes. So there's a lot of difference between the portfolios, but there is also some crossover there.
John, I suppose the potential investments open to the smaller companies fund is it's larger and it's different to the potential investment set to the SMAs. So we can look at companies that the SMAs could not consider investing in simply because of size and liquidity. So that changes how relatively attractive an investment might be. You could imagine a case where a company in the SMAs would not get into the fund, correct?
Yeah, there could be a case. I mean, I can't think of an example.
I can't think of an example.
But I'm sure there could be a case of that.
Yeah. Okay. And another question popping up is... I like this one. This comes from Inst1. How often do you meet with management of small companies? Now this, I suppose, speaks to a wider issue of the role of management in small companies and the importance of it. John, how do you see the role of management in small companies from an investor's point of view?
Yeah, I mean, management is always important, but I think it's particularly important in small companies. And I try to either speak to them on the phone or go around to their office and look them in the eye for every investment that I consider and put to the team. And so with smaller companies, I mean, there's probably a less developed management structure. So the gentleman or lady at the top has a much greater influence on how the company performs over the medium to long term. So I think it's very, very important to meet management and look them in the eye. So,
Alex, one of the great things is being an investor in small companies is that you can pick up the phone and get the CEO or the CFO on the phone, whereas I've never been able to speak to Marius Kloppers or anyone in a big business.
Yeah, that's right. And we speak to management a lot, and it is a great help in many ways. But it can also be a hindrance, and I can think of one example at the moment. We've talked about it, where speaking to management might not help you. You might hear the explanation for why the business is underperforming and the charisma and just their ability to make you feel comforted when, perhaps they can pull the wool over your eyes. So that risk is definitely there, and you have to be mindful about that. And I mean, there's one stock that I'm looking at the moment where I'm not going to talk to management. I just want to find everything out on my own and hopefully do that without any biases coming through.
I think one of the great strengths of this this team structure we've got here is that we all have different investment styles. So both of you are really good at getting management on the phone or seeing the whites of their eyes in your case, John. I'm completely different. I do not want to hear from management at all. I prefer not to meet management, not to hear from them, unless I have a very specific technical question that requires answering. And I don't think there's a right or wrong answer here. I think that just comes down to how a personal style of investment. I don't feel as though I have the skills necessary to judge whether management is good or bad by meeting them, although lots of people do have that skill. I must say you two both are much better at it than I am, so that works in our favour. But there's different answers to that question. I think the important thing is that we have access to management if it's needed, and we can judge on a case by case basis how important that access is to tap. But yeah, John likes to scare our investment companies by glaring at them.
I try to be nice.
Since I've got you, John, why don't you give us one of your favourite investments in the fund?
Yeah, well, I guess the first stock that comes to mind is iSelect, which was a speculative buy a couple of years ago.
At a terrific price, wasn't it?
Yeah, well, we took advantage of what was panic selling.
Yeah.
Now, there were some reasons why investors didn't want it, but there was management turnover and there was some shenanigans happening in the background, and there was profit warnings, all sorts of things going on, but just the price was so attractive that we recommended it to members. It's done well since then, but we still think it's cheap, and it's more importantly, it's got a decent future. For those who don't know, iSelect is the comparison website. You've probably seen the ads. They've retired Mr. iSelect and they've got different ads.
Yes, I noticed that.
They're constantly advertising. They spend something like 30% of revenue on marketing. And apparently they're one of the best known brands in Australia. And so they're able to get all these people to go to the websites and compare health insurance policies or life insurance policies or car insurance and a number of other energy, broadband, a number of other products. And they've traditionally been mostly health insurance, but they're gradually diversifying. And we think that there's going to be a big opportunity with the NBN rollout. Everyone will be forced to choose an NBN provider over the next, 4 or 5 years. And also with energy prices rising quite significantly.
I haven't noticed, actually.
Yeah.
What I really like about this business and the investment case is that the company has far too much capital sitting in its structure, surplus capital that it can hand back to shareholders. Now, that's a way of generating returns for investors that doesn't reflect on a PE. You won't find it if you're screening. So it gets missed by a lot of investors, but it is a definite way where we can get cash back from the business without it being reflected in the share price. And I think that's...
Yeah, and in fact, that's what they've been doing.
That's exactly what they've been doing,
They're buying back a lot of stock. They've started paying a dividend and now increased it quite significantly.
Yeah.
There's certainly a lot of surplus capital there. It's by no means a highly capital-intensive business. Biggest expenses are marketing employees, and one of the things they've done on the employee front is that they're expanding their office in Cape Town, which is obviously cheaper. Wages are cheaper over there, but it also expands the hours in which they can interact with customers. So it has a few benefits there, and it looks very cheap. Well, it looks pretty cheap at the moment. And hopefully, you can take advantage of the opportunities and do well for the fund.
Okay, we've got another question from Kyle who says, you mentioned you might invest in resource small caps. Most of them may not have any cash or revenues. How do you value such a company? Kyle, I think I can pretty safely say that we're not going to invest in a business that doesn't generate revenue. Am I right in sort of saying that?
So, yeah.
Yeah, the one resource business I was looking at was not a exploration business. It was one that had a very large asset base and was trading at a huge discount to that asset base and had revenues in the wings and things. So, the sector we're looking at doesn't determine the filters we use. We use the same process regardless of filters, regardless of sector. So the company has to be making money and be mispriced for us to be interested in it. It doesn't matter if it's a minor or a nice little website.
Website,
yeah. Okay, one more question here. We've got II gives portfolio weightings for published research on individual stocks. Why would that not also occur for small cap fund? That's from Michael. Michael, I'm not quite sure what you're getting at there. Okay, I think what Michael might be saying, Alex, correct me if I'm wrong, you picked it up last time, is that why are we hesitant to give an allocation when that investors could give to small cap companies?
Yeah, well, I mean, we have, for the companies that we cover on the website, we do give recommended weightings, even for the smaller companies we cover. Right. Where we don't do that is for the companies we haven't disclosed. So these are typically illiquid positions where they are unsuitable for the publication, and so they just go into the fund. And it's for that reason that we can't disclose them, because we would be disadvantaging the investors in the fund. You know, if we give away those positions and the position sizes, the fund might not be able to buy that in the future, and so the investors in the fund would miss out. So we need to protect that for our investors.
Now we've got another question here that asks, can the panel give a case history of a process of stock selection for the fund to date? Let's maybe talk about our search selection. I mean, there's various different skills required in generating investment returns. One of them is simply searching for stocks. How do we come up with ideas, guys? John, maybe you can elaborate.
Yeah, I mean, there are a number of ways. I mean, there's screening tools, and we have access to Cap IQ. So I've set up a few screens that automatically run every week.
But I bet I know what you don't screen for. One thing we don't screen for is low PE, high ROE, right?
Exactly.
I don't think anyone makes money doing that.
Yep. So that's one way. The other way is just to follow all the ASX announcements. So every day we try and flick through the hundreds of announcements on the ASX, reading the AFR and other newspapers, just understanding what's going on in the world, and thinking about the effects of political decisions. I mean, an example is in the US, where they're trying to crack down on, well, if the president gets his way, he's going to crack down on immigration. And so a lot of IT services companies have been sold off over there because they're worried, or investors are worried, that they won't be able to replenish their employees, because a lot of them are on these visas that they're trying to crack down. So there are a number of ways you can find ideas. It's just about being open-minded and imaginative. And the latter is something I need to work on. But you know, if you just think about, if you see an event happening in the world and think about, well, what are the effects on particular companies, and just go from there. It's one way to do it.
It's great having lots of people using their own unique ways to look for stocks. I mean, I swear I've seen Alex just trawling through companies based on alphabetical, where they are in the alphabet. Is that right, Alex?
Yeah, I've done that from time to time.
It's the old Warren Buffett suggestion.
The old Buffett suggestion.
Start with the A's.
Yeah.
One thing I've been doing recently is just thinking about how important psychology is to creating investment opportunities, and so I've been trying to think, where is psychology hugely skewed in one way?
Yep.
Trying to identify that, and then think about, you know, perhaps how that might be misplaced. And there's actually thrown up quite a few interesting little situations.
I can think of one business in the fund that's exactly the way we came to it. We're looking at a particular sector in the market that had been really beaten down, looking for something in that sector, and we found it. I think that's a terrific way to look for companies. The other way that I sometimes use is I probably use sometimes screens that screen for really bad quality. So if a business, I want to know about businesses that have cut dividends, that are generating, that have really high debt levels. I think a business that has stable cash flows but really high debt levels can be hugely mispriced from time to time. And in fact, that's how we came across PMP, a business that had stable cash flows and really large a debt load. The other one that's quite interesting is when you see EBITDA margins turn negative for a couple of years after a long run of decent margin. I think that's a situation that's worth looking at too. So
absolutely, particularly in small caps, because small cap investors are fair weather friends, and you know, you can have good businesses.
That's pretty mean, Alex.
It's so true though. I mean, a company can be decent and have a good future ahead of it, but if its earnings dry up temporarily, it can get completely deserted, and that can be a huge source of opportunity. So. Yeah, I really agree with that too, Gaurav.
Now, we've got a comment from Greg saying, what kind of long-term investment do you expect? I think this is do we have a targeted rate of return?
It's at least 5. Well, our aim is to beat the benchmarks of the 5 years. I think I suggested time frame is 7 years.
Yep.
And we do have something of a track record already. Am I being a bit? I'm
It's probably a little early.
A bit early talking about that.
Yeah.
Well, we've been fully invested since February, and we've been the beneficiaries of a couple of large and well-timed takeovers of some of our big positions. But Alex, so far since February,
We have done just shy of 18% after fees. That was the figure. I think it was 17.7 or so this morning. So yeah, we've had some fortunate gains thus far, but it's early days.
It's early days, yeah.
And I mean, we were lucky in that we were considering GBST and elected not to. And
well, that's an interesting example of how the very specific structure of the fund works. We were judging GBST against a completely different set of alternative investments. We chose the alternative investments. I don't think anyone in the committee recognized the weaknesses of GBST at that stage. We just had better stuff to buy. Stuff that wasn't open to the SMAs. So, sometimes you get lucky, but sometimes the structures you put in place lead to better outcomes. I think that's what happened in this case. Now we've coming towards we've got a little bit of time left. Let's take another question. Can you please comment on the likely impact of a significant market downturn on the small cap fund? So this is probably something. This is something every investor has to deal with at some stage, and the way funds deal with it is really important, can be very different. Alex, what happens when 12 months from now everything is going swimmingly and then we're suddenly hit with a large external event, the market falls? How does the fund react to that sort of event? Does it react to that sort of event?
Yeah, well, I think I remember when I first started investing, I often wanted to try and predict such events and think about them and try and prepare for them. And I think when you admit that they are unpredictable and you just go about finding good businesses and build a portfolio around that, I think you put yourself in a better position to generate good long-term returns over time. When you're worried about the market crashing and that sort of thing, you're going to be underinvested and you're going to hold back when you probably shouldn't be. So we're not trying to predict what's going to happen with the market. We're just trying to build a portfolio of good companies that we think can do well in most market conditions. And it's possible that the market corrects. We could have an external event. We could have issues in North Korea, or anything could happen, and the market could fall a lot. And there's little you can do really with that. But what matters is how you rise out of that, and how you take advantage of such opportunities.
So there's a role for us as the custodians of other people's money in managing that well in that period. I think this is where there's also a role for the investor as well. I mean, we ask of our investors that they understand and are sympathetic to our investment style, which is patient, long-term, and deeply contrarian. So, John, what we don't want is to attract the kind of investor who is in there while things are good and pulls their money out at the first negative. The fair weather friend.
Yeah.
There you go.
Yeah, ideally. But obviously that is an option if you so choose. But we would hope to, as you correctly say, we'd hope to attract the investors who think similarly to how we do. So long term, we sort of take advantage of market downturns. I mean, that could be a situation where if the fund was closed, it'd be an opportunity to raise further capital to put to work at hopefully lower prices. But as Alex has said, it all depends on the opportunities out there, and we don't really care about what the market is doing.
Yeah.
Except if it gives us more opportunities to take advantage of.
I can't think of a time, even when the markets were fully priced, and they've been quite dear of late, we've always found pockets of value, and sometimes we've had to apply ourselves and scratch our heads a bit more than normal, but the value is always there if you're willing to look for it. It's a big market. The great thing about small caps is that it's a bigger market. There are you can delve even deeper, and you can go a little bit smaller. I might just comment on one of the businesses that I quite like in the fund. We've all actually lowered our position a little bit in it, but I think Fleetwood is a really interesting example of how an investment in this sort of structure can yield better outcomes, because it's a position that's required a little bit of portfolio management, and we've used our skills as portfolio managers to get, I think, better returns than maybe just by sitting it and letting it sit there and do nothing over time. A lot of these businesses that we look at Some of them are really high quality, smaller businesses. Some of them are not exactly what you'd call high quality businesses, but they are very, very cheap. And the ones that are very cheap, we really have to manage those position sizes and clip them once they start getting larger, simply as a risk management strategy. Guys, let's go to a final question. What is the cash weighting in the fund? Is there a minimum or maximum? There's a lot of different ways to think about cash. Seth Klarman thinks about cash as the default position, and he only invests when there's a better outcome for his investors other than cash. But cash is sort of where he defaults. A lot of investors will see that as quite extreme. How do we think about cash in this fund?
I think cash gives you the option of taking advantage of cheaper prices. So I think the cash weighting could be anywhere between 0 and 50%. Now they're the extremes. I mean, over the long term, I think it'd be closer to 10 to 20%. But it'll all depend on the number of opportunities.
So at the moment, our cash holding is,
I think it's about 30%.
Yeah, it's about 30%. It's a fluid situation now because we are getting flows.
Yeah, so we're trying to put those flows to work.
Yep.
How do you think about cash in the fund, Alex?
Yeah, in similar terms, I think it provides optionality. So you want to have some when you need to put it to use and when there are opportunities there. And this fund is a little bit different because we are subject to redemptions and we also have illiquid stocks. So we need to have higher cash balances than perhaps the SMA product.
Yep.
Just to meet those two forces there. So
that's a really important point. So for a lot of people watching, 30% may sound like an unusually high balance, but you're right. When you consider that we have to have some cash in place to meet redemptions, and also some of our positions are very illiquid, and we do need cash in place in case we cannot sell them or need a bit longer to sell them. So for us, yes, cash is a buffer and a weapon, and depending on how the market is doing, we can either use it as a safety net or use it as a spear.
That's right. But I would regard 30% as being marginally underinvested at this point.
Yeah, I would agree with that. I think we're all looking for somewhere to put it.
Yeah, I mean, we've got ideas we're working on, so that could change in the medium term.
Okay. Now, in terms of risk management, we sort of talked about our cash position. We've talked about how we use position sizes and changing position sizes to clip excessively growing positions. There's also our internal investment process that acts as a risk management tool. Alex, when a company is suggested for investment, there's a long process before it gets put into the fund, isn't it? It takes a bit of time from idea to actual invested idea.
That's right, yeah. And for me, one of the biggest things is asymmetry. So I'm looking for an idea where if I'm wrong on it, I'm not going to get murdered and lose all my money. And so it has that downside protection there. And on the other side of the coin is that it has some opportunity for return. So if it doesn't have those characteristics, generally I'm skeptical about it and looking for other things. So that sort of helps with the screening process, and in the analytical process, you're looking for things which gives it those asymmetric properties. And so that's a big part of the risk mitigation process.
Jon, it's important to have another set of eyes and a dissenting voice when you're looking at a company and trying to pitch it to the fund. One of the things I find difficult is, sometimes you've looked at a business for so long, you're almost emotionally invested in itself, and that's where again the committee structure, Dragon's Den process comes in handy, where skeptics, with peers with a skeptical mindset, you come and take the company apart. We still are looking to do that for every idea that gets.
I mean it's a very similar process to how buy or spec buy ideas get published to the website. I mean, the relevant analyst does the research, puts together a presentation if he thinks it's appropriate, and then presents it to the team. In this case, it's the investment committee, but it's exactly the same process. I mean, hard questions will be asked, and it's really a test to see whether everything's been considered, whether anything's been missed. If so, then it gets rejected and further work is required.
Yeah.
So.
And that happens quite a bit. I mean, there's been several, well,
Yep.
plenty, in fact, of companies that have not passed the muster. I think that's exactly as it should be. If all your ideas are getting through, then your process isn't stringent enough.
I think it's, you mentioned earlier that we have different investment styles, and I think that's one of the main positives of presenting it to a team.
Great.
Because, I mean, I have my own preferred style, but I might miss stuff, as you said, perhaps because I'm emotional about a stock. I like it so much, and I've let that emotion affect me. So it's good to have the team who are less emotional and perhaps have a different style to, ask the questions and see whether I'm actually correct or not. So.
Yeah, no, investing is funny that way because emotion is the enemy, and in our everyday lives we try so much to bring a different level of emotion. When it comes to work, I think we all try and just bottle it all down and make sure none of it comes out. All right, look, we better wrap it up there. Thank you, Alex and John, for joining me. From the team at Intelligent Investor, thanks for joining us. If you want more information on the fund, if you have a question that didn't get through, or you have an additional query to ask, get in contact with us, send us an email, give us a phone call. I think we even have a Twitter page you can use, so you can contact us that way. Thanks for watching.